Hello and welcome everyone. Today we will speak about the life insurance industry, and what a time to speak about that industry. We are in a year where there is a strong growth which the industry has in front of itself, but at the same time there are certain regulatory changes in the form of surrender value. There is some bit of margin pressure which the companies in the sector are experiencing because of the strong sales of market-linked products, and in that, how do companies want to navigate the growth for themselves in this financial year? We're joined by one of the industry leaders, HDFC Life Insurance, Vibha Padalkar, ma'am. Ma'am, thank you so much for having this interaction and sparing the time for this interview. Let's start by something where we left off in the previous interview itself. You had guided for a 15% growth when it comes to the APE as well as the retail APE. Now, I want to, of course, draw your attention to three things that have happened since that interaction. First quarter, your total APE has grown at 23%, retail APE has grown at 30%, much ahead of what you had said. Second quarter is expected to be very strong because surrender value regulations come in from October. Fourth quarter is seasonally strong. All you have to manage is the third quarter. In that sense, 3 out of 4 quarters firing very strong ahead of your estimates. Could we have an upward revision to that 15% number on both APE and retail APE?
So yes, as a sector, I feel very proud that despite very significant changes that happened in the last budget, how as a sector we have come back with a bang has been phenomenal, and that's what makes me really proud. Yes, we had a flattish or slightly degrowth for the sector last year, and everyone almost wrote us off, and so yes, it's been a good first 4 months. As of now, given that there are some fairly significant regulatory changes on the anvil, we are holding what we said. Internally, of course, we're targeting a slightly higher number, but we had said 15%, which is on the upper end on a full year basis. Yes, it's looking pretty good in terms of first 4 months, and like you said, upwards of 30%. But let's also be honest that there was a base effect, and so numbers for us and for everyone else is slightly looking more elevated. On a 2-year CAGR basis, it's in the mid-20s. And that's what, so it's not very different to where we are saying 15% internally targeting a little bit higher numbers. But I think I'll have a better view once the surrender charges and that new regulations are implemented. Lots of things will undergo a change. And I think right now we just want to go with focusing on business. So
15% is the conservative view that you would want to share at this point of time, but there is an upward or a positive bias internally that you have.
I would think so. All things being equal, on the regulatory front, 1st of October it comes into being, because then you can build a business model around it, and with very little in terms of further changes, then with the stability of business models, yes, there should be a bit of an upward bias on it.
Okay. A little on the value of new business as well. Do you expect that side, which will of course be a function of the margins also, but do you expect it to grow in tandem with the APE growth? And you've spelled out a 4-year target also towards that.
That's right.
But would it grow every year for the next 4 years in tandem with APE growth, or could it exceed that?
It's become a way of life that at least you will double your VNB every 4 years, regardless of the ups and downs. And there will be very young sector, and there will be something or the other that we have to look at from a business model change perspective. And so nothing has changed. That's what we have been delivering in cohorts of 4 years, and we will continue to deliver. Again, top line doubling and VNB doubling. Whether it's 4 or 4.25 years, so we are saying about 18%. Between 17 to 18% is 17.5, 18.5. That kind of a range is what we have been delivering, and that's what we are internally targeting.
Okay. A little bit on the margins, because that has become the center point of discussion for this financial year. Your first quarter ULIP share went up to about 38% of individual APE as compared to 25% year on year, and we've seen that gradual increase since the last few quarters. Now, you've said in the conference call after the first quarter that you expect ULIP share to moderate. Now, I assume that large part of that, significant part of that moderation, you are indicating that it will come because the other product categories will grow, will take a higher share, and not ULIP share will come down largely. In that situation, I want to understand by the end of this year, with other product categories growing and taking a higher share, where do you expect the ULIP share to be over where you ended FY24? And in terms of margins, if that moves as per your understanding, the ULIP share, onto your margins, where do you see them? Where do you see yourself ending FY25 at?
I don't even have to wait till end of the year.
Okay.
We are already there. Okay, so happy to share that whatever we have said, that ULIP was elevated thanks to the markets. It's already coming close to about a third of our business. Some of our channels are sub 30%.
Okay.
Right, so it's already been achieved. Our non-par, I'm happy to share, is growing at and in the first quarter itself grown by about 41%. Happy to share that our latest avatar of Click to Achieve has been 100 crores in 16 days. Right? So we will continue to be a product factory, an innovator, and we will continue to launch products that we think are relevant for the customers. And ye naya kya hai question for us to keep going back, for our partners to keep going back, that is something that will continue. So it is important for us, and we've already, the limited point is, we've already started demonstrating that ULIPs are quite at a range that we are reasonably comfortable.
ULIPs, of course, coming in the comfortable range. By the end of the year, by the next couple of quarters, which product segment do we see actually accelerating as a share of the individual AP where we stand today?
Definitely non-par. And like I said, we've just launched this blockbuster product. So that's showing very good traction. Also, in terms of the impact in the new regime, it's something that we have been talking to our partners and seeing how it can be mitigated. So if that settles down, then that segment should do reasonably well. Term is continuing to grow faster than company level growth, and so we had about 28% growth in term in the first quarter. On sum assured basis, very good numbers, about 46% on retail sum assured that we've shown growth on. So term should nicely continue to increase, and annuity as well. Even with annuity, to some extent I have called out irrational pricing on annuity, wherein if I'm giving an annuity today than any instrument that I could possibly lock into, else I'm giving a rate wherein it means zero spread for the company, then not much interest that I have in a product like that. Right? So we do believe that a little bit more rational behavior, like we are beginning to see a little bit more rational behavior on term pricing, that rational behavior will start coming into annuity pricing also. Okay. So term, annuity, non-par, I do expect to see an uptick.
You've told me protection will grow, you've told me non-par will grow, you've told me ULIPs have come down. What does that leave you in terms of an estimation on the margins for the year?
This year, like I have articulated on our call, we're not tethered to a margin. Last year we ended 26.3%. Correct. I don't want to be tethered, and I'll explain why. At the same time, the caveat is we are not looking to drop margins by 400 to 500, 600 basis points, which has not been unusual in our sector. Correct. So I'm not talking about that margins could be free fall as long as I give the top line, like I mentioned to you. That's not what I'm saying. Now I'm saying that, like in our earlier part of today's interview, that I will grow top line, I'll double over 4 years. I will do the same thing in terms of VNB. Correct. Margins will be range bound, give or take 26.3, 100 basis points, 150 basis points here or there. It could be, because my focus and the ranking of priorities has been top line growth, so that we continue to be slightly higher than overall industry. Right. Second is VNB growth. Margins will be an outcome of that. Only reason I'm saying that is because of unit linked. The fact that equity markets are still very, very elevated, I don't want to say no to good business, although it comes in through the door as unit linked. Now,
you mentioned about protection, and I want to come to that. The first quarter protection growth of individual AP was flat at about 6%.
No, the growth was 28%.
No, the share.
The share, yes.
The share,
yeah,
the share was 6%.
Yes.
14% of total AP versus 18%.
Yes, correct.
32% of NBP versus 37%.
That's right.
So, somewhere it remained flat as it was.
Yes.
Somewhere it came down.
Yeah.
what came in that strong story for protection that we were talking about, and do you expect this to continue for some time, or do you expect this to bounce back if it was just a one-off from the next quarter itself?
Yeah, so let me deconstruct it. Like you said, retail protection, very strong growth. Credit life was flattish, and hence overall number as a percentage came down.
Okay.
Credit life, there are 2 or 3 parts into it. So the MFI book is about 1/3, and we know that the pain a lot of the MFIs went through in Q1 and are continuing to go through.
Correct.
Similarly, some of the NBFCs are also going through fair bit of pain. And we also believe in right pricing. So what is the pricing commensurate with the claims that we are seeing? That triangulation means that little bit of slowdown that we saw. On HDFC book though, we are fairly optimistic about getting a pickup in the second half of the year. However, on the rest of the MFI and so on, we'll have to wait and see in terms of how some of the geographies are going through, especially some of the northern states, how are they going through their experience on NPAs and so on, as well as for our industry in terms of the claims, in terms of right pricing. So a little bit of state of flux is there. I would expect, given that we are the largest player in the credit life space, and given that we want to be fairly calibrated on pricing, it will be, the growth will be lesser than retail protection, as a result of which you will see that the kind of outcomes, very similar outcomes you will see as you saw in Q1.
Okay.
But that is okay because the uptick in VNB continues to be strong. The number of lives covered continues to grow, and the sum assured is growing almost by 46%.
Correct.
So we will grow the book faster and healthier than an overall savings book, and that's a good place to be.
Is there a strong sale from the end of your distributors before the new surrender value or the higher surrender value guidelines kick in? And in that sense, could September be a very, very strong month in terms of sales, just on the back of making the most of the last 15 days?
It could be for the sector. It won't be for us. We will not do any fire sale. The paradox is these products, why is our regulator bringing out these changes? Because the products are going to be better for the customer. What is the implication of a fire sale? That means something good is going to go away and hence buy something in a hurry. The products are going to be more customer friendly. So we will stay away from a product sale. And we've had conversations with our partners that we will not do any fire sale. The products we are not going to reprice our IRRs because of these regulations. It is going to be what they are. And the products, because of the surrender charges, are going to be better.
Correct.
Right? So it's going to be businesses. If we reprice, it's only going to be what we would have normally repriced because of interest rate movement.
Now, just to extend the question of surrender value, October 1, we have about less than 1 month to go before the new guidelines kick in. Personally, if I have to speak to the company, do you require, are you in any need of any extension to that timeline? Or do you think you're completely prepared and you'll be able to roll out all your new products before that 1st October deadline kicks in?
I'll answer this in a couple of parts. One is that yes, we are ready. This is the regulator's endeavor to make products better for the customer, and we respect that. And whatever pain that the industry goes through, in the larger scheme of things, it will hopefully expand the market. It will increase the trust between customer and us. So how do we move towards it? And also this has been told to us a few months ago, so we've had some time to digest it. That technically the products that are not compliant have to be withdrawn. So our appeal and our ask has been that let us not, give us a little bit more window period, say 1 quarter, of products that are not compliant, not to withdraw them. But at the same time, fine, we will not sell those products, but let us not withdraw them. It's a technicality, because otherwise I have to perforce withdraw them.
And then refile them.
And then refile them. That will mean delay and a lot of work for the regulator as well, and so on.
Just to extend this question, as far as the new products are concerned, what do they entail on the pricing side? on an average, what could be the increase in price for you also to sort of make that little bit of legroom for the extra surrender value that you'd be paying? Is there any change at all that comes from the pricing? If yes, then if you could help us understand with numbers, what could be the average increase in price?
I think you mean decrease in IRRs, right?
Yes.
Yeah. So I think there will be some calibration in terms of IRRs for the sector. However, like I had mentioned, for us, there's not going to be a material change due to these regulations, and I'll explain why. First of all, we do dynamic pricing, and if you look at our IRRs over the last, say, 24 months, you will see that when interest rate movements happen, we reprice immediately for new business. What I've already sold, I can't reprice, but for new business. So that is number one. Number two is our persistency levels are fairly decent at about 92% in the non-par book. So that also helps us because the surrenders themselves are fairly low. Also, most of the guys who exit become paid up. So they're still our policy holders, and so the surrender amount what hits us is contained. As a result of which, the amount of tweaking that we'll need to do on IRR repricing will not be material.
One question in terms of course, what the new surrender value regulations also bring is the change in the commission structures. We will see a lot more of deferred commissions coming in. We'll see clawback of commissions coming in, especially on the bank side. Of course, individual agency force, you can't do clawback. A combination of these two, which will dominate in terms of the larger size of the book? Would it be deferred commissions or would it be clawback? And with the extent that you would be applying deferred commissions, how does the balance sheet work in terms of the impact on the cash flow simply? What could be the quantum of increase in the cash flow that you could see because you're paying those commissions in a graded fashion?
I would see this solutioning as being bespoke. And before I get into which one and so on, this is a tectonic shift because the product architecture itself is undergoing a significant change, which was never the case earlier. And even PAR, which has been around for 44 years longer than when we were born as a sector, private sector, itself did not have this. So we are changing the game very significantly. As a result of which, there has to be skin in the game between customer, the intermediary and the manufacturer, which is us. With some companies, there will be customer will have to bear the IRR. With some companies, the distributor will have to bear more. Sometimes the company itself will have to bear. What is the sharing of it will be bespoke depending on all the nuances of the relationships and pricing power as well and many other such things. Okay. Now, where we are concerned, these are some of the tools wherein we have said that whatever is the impact, we will try to minimize it to a non-material impact, which will be a combination of clawback and deferred commission. Okay. And little bit we might absorb, like you said. Cash flows could see the cash flows could be a little bit more favorable because if you're going to pay only, in my example, 80%, then 20% you will retain and then you will do a true up down the line. But it's not really going to be a P&L impact, and I'll explain. So if you think that you've paid cash of 80, but you're likely to pay 90, then that 10, any CFO will say, I have to provision for it.
So far in the year, have you taken any price increase as far as the protection book is concerned? What has been the quantum of that price increase? And was it more of an installment of a larger price increase that you want to take? And there could be more lined up for the balance part of the year. And if yes, then what could be the balance quantum that would come through?
So it's not that carte blanche we have taken a pricing increase the way you saw during COVID. It's very nuanced in a particular cohort of policies that are exhibiting poorer claims.
But 10 to 15% has happened in the protection book so far. Is that the...
In certain cohorts, yes.
Okay.
At the same time, in some of the other cohorts, during that time, nothing has happened.
Correct.
Or even a reduction might have happened.
Are you experiencing exactly to the point that you made, which pushes you to take that price increase more in the balance part of the year?
We will. See, there are many nuances. For example, somebody who does not have access to good health care or nutrition. And as we move wider, there will be some of these nuances.
Okay. One final question as we conclude the interaction. IFRS, that's the next big thing as far as accounting is concerned. A lot of things change. Your expenses do get spread out across the term of the policy, which impacts AP, VNB margins. How prepared are you with respect to IFRS? What is the internal understanding in your conversations with the regulator in terms of applicability of IFRS onto life insurance companies? And if it happens, could you give some estimation in terms of what could be, taking the current financials that we have in our hands and putting them as the prototype, what could be the increase in margins? What could be the impact on AP?
On the last question, no increase in margins because this is economics don't change.
But
it's
because
only the
your
accounting.
expenses reduce and the
Economics and the margin will still have the expenses.
Okay.
Regardless of how you show your expenses will be incurred. Like we are incurred. There are no expenses today other than say depreciation that is not expressly in cash. And even depreciation in capex I've incurred it in cash. So there's no.
But denominator falls because AP shrinks.
AP shrinks, unit linked will shrink the way we know unit linked. So the optics of the margin will depend, what it is. I don't want to jump the gun because some of the detailed insurance contract accounting is still not ironed out, and so and there are many avatars of it. Will it be Indian suitability for some of the products, given how large unit linked is for some companies and so on. So going back to your first question, we will be prepared and we will meet whatever timelines that the regulator wants us to.
What should one expect in terms of timeline?
I think we should expect in the forthcoming fiscal.
Thank you so much for speaking to us for this extensive discussion. All the very best for everything that you've planned out for the company. As always, it's lovely speaking to you. Thank you once again.
Thank you so much. Thanks.